Hello and welcome to part 2 of the chapter 12 lecture. In this section, we're going to look at the entries for admission of new partners because we're still talking about partnerships. We're going to look at the entries that are necessary when a partner leaves, and we'll finally look at what happens when the partnership ends and it's liquidated. Or another word of saying that is we sell off all of our assets, and the definition of a capital deficiency. So in the previous video, you were able to see the entries for the formation of a partnership. When a new partner comes in, it looks very similar in some situations. In other situations, there could be a bonus. So we'll talk about that as well as what the definition of a bonus is. So when a new partner comes in, the old partnership is done, because you can't have partnership A and B and C wants to come in and we say, okay, C, you can come in. It's not partnership A, B anymore. It's partnership A, B, and C. So the new partnership is typically immediately formed. All the partners, all the old partners have to accept the new partner. They have to agree on it. And a new partner can come in one of two ways. They can either purchase the investment or the interest of one of the old partners, or they can bring assets into the partnership itself. Now, when a new partner comes in by purchasing the interest from another partner, the partnership does not receive any cash. The cash portion is a personal transaction between the old partner and the new partner. All the partnership has to do is switch out names. We're removing names. So the total assets and the total equity, it doesn't change. But if a new partner comes in and they bring in cash or other assets, then total equity will change and total assets will change. And I'll show you what I mean on the coming slides. So let's see this example. We're still dealing with Zane and Perez, but now we have somebody new coming in. So on January 4th, Perez sells one half of his partnership interest to Tyrell Rashid, and Zane has to agree to this. So Perez sells it for $18,000, and Perez gives up a $13,000 recorded interest in the partnership. Now, I know you immediately want to look at this and deal with the $18,000 in cash. The $18,000 in cash, Rashid gives that to Perez. The partnership is a separate legal entity. It does not receive any cash. It does get a new partner. Perez gives up half of his partnership interest. Now, the fact that his partnership interest was worth 13 and he got 18 for it, that's something he's going to have to deal with on his own taxes. Rashid will have to deal with that when the time comes on his taxes. But in terms of the partnership, we don't care because we are the accountants for the partnership. The cash doesn't make a difference. The only thing we have to do is take half of Perez's capital off the books and we give it to Rashid. Notice that total equity remains the same. So we debit Perez capital for $13,000 and we credit Rashid capital for $13,000. Now, that's what happens when a partner comes into the partnership by purchasing an interest from one of the old partners. But if a partner comes in by bringing in assets, then of course the journal entry is going to look different because both assets and equity will increase. Both sides of the accounting equation are impacted, whereas in the previous one, only the equity section was impacted and it canceled each other out. So now we have Rashid being admitted to the partnership with a payment of $22,000 cash. That $22,000 cash is not going to Zane. It's not going to Perez. It's going to the partnership as a whole. So when we do this entry, we debit cash for the cash coming in. So that's my asset side of the accounting equation going up. And we credit T. Rashid capital. And that is my equity side of the accounting equation going up as well. Now, that's pretty straightforward. When the partner brings cash into the business and the business gives them an ownership interest that's equal to the amount of cash that they bring in. But sometimes partners will come in and they may bring in more cash than the partnership interest that they'll receive, or they may bring in less cash. In other words, they may bring in 50,000, but we're going to give them a capital balance of 25,000. Or they may bring in 50,000 and we'll give them a capital balance of 100,000. The difference between what the new partner brings in and the capital account balance that they receive is known as a bonus. Sometimes bonuses are paid to the old partners, and sometimes bonuses are paid to the new partners. It just depends on the situation. When a bonus is paid to the old partners, what that means is that the business is worth more than what's on the books. And having someone come in, we have to ask them to bring in more money than the investment that they will receive, because the value of our partnership is worth more than what the books actually say. So in other words, the old partners are like, I'm doing you a favor by letting you come into my business, so you have to pay me a bonus. Now, when a bonus is paid to a new partner, the new partner may have some type of exceptional talent or some type of skill that they can bring to the business that will launch the business forward. And in that situation, the old partners are begging the new partner to come in. Please, please, I'll give you extra. You don't have to pay as much. Come in, be a part of my business, and I'll give you a capital balance that's more than the cash that you'll have to bring in. So let me give you a real sort of, well, it's not a real example, but let me give you an example. Let's say that I had a partnership and it was my own basketball camp. I'm really short and I didn't make it to the NBA or even the WNBA. So I have a basketball camp. And in my basketball camp, all of a sudden, I'm able to get in touch with Michael Jordan. I typically would use Kobe Bryant, but I can't use Kobe Bryant at this moment, and you know why. But let's say there's Michael Jordan, and I'm like, Michael Jordan, I have this great basketball camp. Will you please be a part of my basketball camp? Don't you think that I would say to Michael Jordan, give me $1 and I'll give you a $50,000 interest in my partnership? Because if I have Michael Jordan's name attached to my basketball camp, then I'm going to get a ton of people who are going to want to come to my basketball camp. That's an example where a bonus, I, as the old partner, paying a bonus to the new partner because of the new partner's exceptional talent. Now, let's say that Michael Jordan, again, I would normally use Kobe Bryant, but let's say that it's Michael Jordan and LeBron James, and they already have a basketball camp. And I come in saying, hey, I have some accounting skill. Can I be a part of your basketball camp partnership? And they look at me and they say, okay, what we have on our books is worth, it doesn't cover our value. We're worth so much more than that. So you can come in, yeah, you have some talent, but what we have is worth way more than your talent. You can come in, but we're going to make you give us $50,000 for a $10,000 capital balance. In that situation, LeBron James and Michael Jordan are the old partners. And as a new partner coming in, I'm paying a bonus to them. So let's see this in terms of numbers. Hopefully that will help this whole thing to make a little more sense. So we're still dealing with Zain and Perez, and Rashid wants to come in. So Zain and Perez agreed to accept Rashid as a partner upon his investment of $42,000 cash in the partnership. Rashid is supposed to get a 25% ownership interest in the new partnership. Any bonus gets shared equally among those existing partners. So the first thing we have to do is calculate Rashid's new equity balance. Yes, I want to rush and I want to do the entry and show that we have $42,000 coming in, but I don't know Rashid's capital balance. It's not necessarily $42,000. Let's do the math to see what it is. To determine the math, we take the equity of Zain and Perez, the old partners, and we add in what Rashid is bringing in. because Rashid is supposed to get 25% of the new partnership. The new partnership includes Rashid's cash. So I have to add that in. That's the tricky part of this. Don't just take 25% of the old partner's equity. That's not the new partnership. That's the old partnership. Add in what Rashid brings in and take 25% of that. So from that, we see that Rashid's equity balance is 25% of the 120,000 or 30,000. Well, wait a minute. Didn't Rashid bring in $42,000 in cash? And his capital balance is 30,000. In this situation, Rashid is paying a bonus to the old partners in the amount of 12,000. That difference between what Rashid brought in and Rashid's equity balance. So clearly, Zain and Perez's business, the value is not reflected in this $78,000 or in this $120,000. Their business is worth more, so they are making Rashid give them more money for a lower investment. So when we do this entry, there is no account called bonus. What we have to do is increase the partner's capital accounts for the amount of the bonus. We're told in the last sentence of this problem here that any bonus is attributed to the existing partners and it's shared equally. So we cut that bonus in half. We debit cash for the amount of cash that Rashid brought in. We credit Rashid capital for his capital balance or equity balance that we determined on the previous slide here. And that difference is the bonus. I like to look at this and say, okay, I know if I debit cash for 42 and I credit capital for 30, I need more on the credit side in order to make my entry balance. And when a bonus is paid to old partners, it increases their capital account. So I know I'm on the right track here. That means I need to credit Zain capital for half of the bonus and credit Perez capital for half of the bonus. What about, let's flip things around. What about when the bonus is paid to the new partner? Well, we still calculate Rashid's equity balance in the same way. Our journal entry is going to change because instead of crediting the old partner's capital accounts, now we're debiting their capital accounts because they're giving a portion of their capital to the new partner. So we're still dealing with Zain and Perez. Rashid comes in, and Rashid only has to bring in $18,000 cash. Well, that really doesn't mean much to me right now. Rashid is supposed to get 25% of the new partnership. So let's determine the value of the new partnership by taking the equity of Zain and Perez, assuming this information was given to us and provided to us before. We add in what Rashid is bringing in, $18,000 cash, and that gives us total partnership equity. We multiply that times 25%, and we see Rashid's equity balance will be 24,000. But wait a minute again, because we only asked Rashid to bring in 18, and we gave him a capital balance of 24. That means that those old partners paid a bonus in the amount of the difference between this 24 and 18. If I can subtract today, is 6,000. That bonus is being paid to Rashid. So here is our entry. And whenever you're doing an entry like this, attack it with what you know. You know you're debiting cash for 18,000. You know 18,000 is coming into the business. You know you're crediting capital for 24. We just calculated that. The difference between that is 6,000, and we need more on the debit side. We're told that Rashid has excellent business skills. So that means the old partner is paying, two of them, the old partners are paying a bonus to Rashid that reduces those partners' capital accounts, and we debit their capital accounts for half, assuming that the bonus is split evenly among the old partners. Now, the same way we can have a bonus. When new partners are coming in, there can be a bonus when old partners are going out. So let's look at the entries for when a partner leaves the business. Also, in the same way, we can have bonuses The same way a partner can come in, it's the same way they can go out. They can sell their interest to another person, or the partnership can give assets, cash, to that leaving partner. So let's see an example first with no bonus. At the date of withdrawal, at the date of the withdrawal of Perez, the partners had the following capital balances. So we see Perez has a balance of 38, Zain has a balance of 84, and Rashid has a balance of 38 as well. The partners share in income and losses equally, and Perez is to receive $38,000 cash upon withdrawal from the partnership. Now, this works. And I say this works because there's no bonus. Perez has a capital balance of 38, and the partnership gives him $38,000 in cash. He got exactly what his equity balance is worth. So no additional accounts that need to be debited and credited. Just take Perez off the books by debiting that capital account and crediting cash to show the cash coming out of the partnership. Now, in some situations, the partner may leave, and when the cash is paid, it ends up being less than what the partner's capital balance is. So at the date of withdrawal, we can see everybody's capital account balance. Focus on Perez. His is worth $38,000. Perez only gets $34,000. So Perez is saying, look, I'm tired of working with you guys. I know I'm supposed to get 38. I'll take 34. Just please, I'm done. I can't handle it anymore. And the other two partners are like, great, because that increases our capital accounts for the difference. So in this case, Perez is paying a bonus to the old partners. He is accepting less cash than what his capital balance reflects. The partners share in those bonuses equally, so we cut it in half and we increase Zain's capital for 2 and Rashid's capital for 2 as well. Now we can flip this situation around. Now we have Zain and Rashid saying, Perez, we're tired of working with you. We know that you should only get 38. We'll give you 40. Just go. Leave us alone. In that situation, we see that Zain and Rashid end up paying a bonus to Perez, and they reduce their capital accounts. Now, when it comes to the concepts that I really want you to focus on, I want you to understand conceptually what a bonus is. You may not find too many questions on the test in terms of entries for bonuses, whether it's an acceptance of a new partner or withdrawals. And I do that because there's just not a lot of partnerships nowadays. Most companies use LLCs. So I don't heavily test you on this, but I do want you to understand what a bonus is. And I want you to understand this because I want you to be able to see the positives and negatives of this form of business. What happens when a partner dies? Well, when a partner dies, it's the same as when a partner leaves. The partnership ends at the date of death because the partner that passed away, their estate has to be settled. So we need to know the value of that partner's capital account as of the date of his death. The business can't continue if he or she is no longer there. So the books are closed, and we find the current market value of the assets and the liabilities. Sometimes the heirs of that partner will take over that partner's share of the business. Of course, the old partners have to agree to that, but even still, the partnership dissolves. It can be immediately reformed. But if a partner happens to pass away, you close the books as of the date of death. You find the fair market values of the assets and liabilities so that you can determine how much income loss should be allocated to that partner's capital account, and you can have the correct reflection of the numbers so that the deceased partner's estate can be dealt with. Now, what happens when we talked about when one partner leaves? What happens when the business as a whole leaves? We call that ends. We call that liquidation. In other words, we are converting all of the assets and liabilities of the business to cash. We're making everything cash, and any cash that's left over, And I'm saying making everything cash, but we're paying off debts and selling off assets, making everything cash so that any remaining cash can be given to those partners. So when a partnership ends, we take 3 steps. The first step is to deal with any gains or losses on liquidation, and that's selling off everything, converting everything to cash. We allocate those gains and losses based on the partnership agreement. We pay off all debts, and then whatever's left over goes to the partners. Because at that point, the only thing that should be left on the balance sheet is cash and equity. So when there is no capital deficiency, every partner's capital account has a positive balance. As long as it has a positive or a 0 balance, then we don't have to worry about one of the old partners needing to pay money into the business, or anyone suffering an additional loss. I don't want to say not suffering a loss at all, because everyone will suffer a loss when the business ends, depending on how much cash they have. But I'll show you what I mean in a second. So we have all of the assets and liabilities of this company, as well as the capital balances of our 3 partners. We sell off the land, because I believe that's the only asset we have other than cash. Yes, we sell off the land, and the land was sold at a gain. So we sell off the land, and we allocate the gain to those partners, and it's allocated equally in this situation. Now we're going to use the cash from the sale of that land to pay off our debt. So we pay off all of the accounts payable. That's gone. At this point, the only thing that's left on our books is cash of $204 and all of the partners' capital accounts with a total of $204. We give everybody their money based on their capital balances. No capital deficiency. If there was a capital deficiency, one of these partners would have a debit balance in their capital account. So let's see, and that could happen if a business has suffered multiple losses over time. So now let's look at this, but let's change their capital balances. So Zane has 19, Perez has 8, and Rashid already has -3. Because Rashid has a -3, Rashid has to give the partnership $3,000 in order to bring his capital balance up to 0. In doing so, it ensures that Zane and Perez will receive what their capital balances are. But this is why I say this is the worst form of business, because what if Rashid doesn't have $3,000? In that situation, Zane and Perez would have to absorb Rashid's loss, and they wouldn't get the full 19 and the full 8. They would get whatever's left over after absorbing the loss. So notice here, when Rashid cannot pay the deficiency, Zane, that capital balance is no longer 19, it's 17.5, because half of that deficiency gets absorbed by Zane and the other half gets absorbed by Perez. So that's why I say this is the worst form of business. Do an LLC, don't do a partnership. All right, that pretty much takes care of all of this chapter. In this video, we talked about the entries for admitting a partner with and without a bonus, new partner, the entries for an old partner leaving with or without a bonus, and we looked at what happens when a partnership dissolves in terms of liquidation, and what happens when there is a capital deficiency. I so appreciate your time and attention, and I hope you have a wonderful day.